Hello there, Prof. Aram here, and in this series of videos, I'm going to go over the concept of cost of capital, or more specifically, weighted average cost of capital, which is also considered the hurdle rate for our capital budgeting and valuation decisions. So let's get to this. From our capital budgeting decisions, we know that the discount rate is a crucial input in the process. So we use the discount rate to calculate the NPV of the projects, meaning that find the present value of the future cash flows and subtract the cost. And if the NPV was positive, we would accept the project. Or if the IRR of the project was greater than the discount rate or the required rate of return, we would accept it. So far, however, we haven't discussed how to calculate this. This was given to you in that chapter, but in this chapter, we're going to combine our earlier discussions regarding the stock valuation, bond valuation, capital budgeting, risk and return to calculate this required rate of return, discount rate, hurdle rate, cost of capital, or weighted average cost of capital. So this thing has a lot of names. The goal here is to learn how firms determine the required rate of return for their proposed investment. And one thing that I want to mention before we start is that we are going to make a lot of assumptions as we move along. So in other words, calculation of the weighted average cost of capital for a firm, especially if you're an outsider of the firm, is more of an art than a science. As we will see, we are going to make a lot of assumptions, a lot of choices along the way, which can determine the cost of capital and basically increase or decrease our estimated cost of capital of the firm. So why is this important? Why do we care about the cost of capital for a firm? We know that the return earned on assets depend on the risk of those assets, and the return to an investor is the same as the cost to the company. So we're looking at it as mirror images, right? So whatever it costs for the investor to provide this capital, that should be the same return for the company in their projects. So minimum rate of return for the company in their projects. Our cost of capital provides us with an indication of how the market views the riskiness of our firm, the riskiness of our assets. And knowing the cost of capital can help us determine our required rate of return for capital budgeting projects. In other words, more broadly, we are going to use this weighted average cost of capital in our valuation of the firm. So value of the firm is nothing but the present value of the future cash flows discounted at the weighted average cost of capital for the firm. And also, this weighted average cost of capital implies that we have multiple sources of capital, and we know that there are at least two sources of capital that are associated with different costs, which are debt and equity. And the thing about this weighted average is that we can't simply add the cost of debt and to the cost of equity and divide it by 2. We could do it if our capital structure was exactly 50% debt and 50% equity. But this rarely happens. Most of the times you have a capital structure that's not as balanced as this. For example, you can have 30% debt and 70% equity. So in this case, we need to average them in a way to account for the relative proportions, which is the weighted average that we are going to see in the later videos. So this required rate of return is the same as the appropriate discount rate, which is based on the risk of the cash flows of the firm. We need to know this required rate of return for an investment before we even start doing the capital budgeting analysis, right? Before we even calculate the NPV on IRR and other profitability index and so on and so forth. So we need to earn at least required rate of return to compensate our investors for financing they have provided. In other words, as I mentioned in earlier videos, corporate finance or business finance is very common sense, meaning that if it costs you 10% to raise capital, you shouldn't deploy that capital. You shouldn't invest that money in a project with an IRR or rate of return of 8%. It doesn't make financial sense. If your goal is to maximize shareholder wealth, you should invest this capital in projects that offer higher rate of return, higher than 10%. Sometimes we can use something called a hurdle rate. So in order to meet the objective of maximizing value, a firm needs to properly allocate its resources. And one of the most important resources of all for all firms is capital. Capital is a limited resource that's available to managers, and you can generate value, you can maximize value for your shareholders if you accept projects with NPV that is positive, or if you accept projects with the IRR that is greater than your hurdle rate. So this concept of hurdle rate is very interesting. Most of the times the hurdle rate is synonymous to the cost of capital or weighted average cost of capital. So this is the minimum rate of return that you should earn on any project. But if the managers of the firm are more conservative, they can have a hurdle rate that is your weighted average cost of capital plus some markup. Meaning that, for example, if your weighted average cost of capital is 8%, you're going to add a 3% markup and have 11% for the hurdle rate of the company. So that also is an important thing that you need to keep in mind. If you want to be more conservative, instead of using the weighted average cost of capital for your hurdle rate, you can just add a markup, 2% to your weighted average cost of capital. And now your projects should meet this minimum hurdle rate in order to be accepted. Okay. Another thing that we need to keep in mind in terms of the calculation of the cost of capital is that we are going to focus on long-term capital here. Especially for calculating the cost of each source of financing, we are going to look at long-term capital. And the reason is that we are going to use the weighted average cost of capital mostly in our capital budgeting decisions. And these capital budgeting decisions are usually medium to long term. So that's why we are focusing on long-term sources of capital, such as long-term debt, common equity, and preferred stock. Some firms use short-term debt permanently. In other words, they borrow short-term and then they just roll it over for an extended period of time. This is basically a long-term debt, but with floating. So it is still a long-term. We can still consider this long-term debt. So these are the main sources of capital that we are going to use in the calculation of the weighted average cost of capital. And then in terms of the components that we will use, we are going to use the capital components that are sources of funding that come from investors. So when you look at your balance sheet, focusing on the right-hand side of the balance sheet, which are long-term liabilities plus shareholder equity. So we are going to focus on the right-hand side of the balance sheet, and we will focus on the funds that are from investors, meaning that from shareholders and creditors. We are not going to consider things such as accounts payable, accruals, deferred taxes. These are not sources of funding that come from investors. So they're not going to be included in the calculation of the cost of capital. These are mostly operating cash flows. And we take care of them when we calculate the cash flows of the project, but not here. but not when we calculate the cost of capital. For the cost of capital, we only focus on debt, common equity, and preferred equity. Furthermore, in calculation of the cost of capital, we will focus on the new or marginal cost instead of the historical cost. So the cost of capital is primarily to make decisions which involve raising and investing new capital for future projects. So in this case, historical costs are irrelevant because they were the cost of capital in the past. What we need to find is the cost of capital today for our future investments. So that's why we will focus on the new or marginal cost of sources of capital as we do our analysis. I hope you find this video useful, and thanks for watching.